Jack Dorsey, he is the founder of Twitter. He recently came out and talked about hyperinflation and the risks of hyperinflation. Now, would you go as far as to say that hyperinflation is going to come and hit the economy in the U.S.?
So not in the near term. That's not my view at all. My base case for a while has been inflation. So higher inflation than we've seen for a while, which is in 2021 we've started to see. Now, if you kind of put your philosophical hat on and think really long term, fiat currencies have historically not lasted very long. This is also the first time in history, the past 50 years that the entire world's been on a fiat currency standard. And so we are in somewhat of an experiment here. And so I don't think anyone should rule out loss of confidence in currencies. But right now the conditions for hyperinflation are not present in developed countries. And so, for example, if you look at the broad money supply in the United States, it's currently going up by about a 13% annualized rate, which is elevated, but it's by no means what you see in say some of those emerging markets that are having major currency failures. And so I can imagine some scenarios that can lead to a hyperinflationary event. But I think it's premature to talk about hyperinflation with the conditions that we're seeing now or in the near future.
Well, let's talk about non-fiat currencies then. Do you think cryptocurrencies have had a long enough track record to prove them worthy of being an inflation hedge?
So a hedge is a kind of a specific term. Generally, with a hedge, you want it to pay off, not just in terms of direction, but also in terms of timing. So like, it's kind of like, for example, if you have put options on the S&P 500, that can be a hedge. If you're long volatility, that can be a hedge because you have a high expectation that it's going to pay off, within the days and the weeks of the event that you're concerned about. Whereas with Bitcoin, for example, we saw that during shocks in the market, it can diverge significantly from what you'd necessarily expect. And so I wouldn't necessarily call it a hedge in the trading sense. But in terms of, say, a long-term place to put capital, if you are worried about inflation, I think at least Bitcoin has had a long enough track record of functioning well, doing what it's supposed to do, what it's designed to do, and achieving a sufficient network effect. And some of the other cryptocurrencies, I view those more like, say, tech equities rather than an inflation hedge, where you're basically betting on that centralized development team to deliver kind of the applications that protocol is trying to accomplish. So I have kind of two very different buckets in terms of how I view digital assets.
Okay. Proponents of Bitcoin have called it a store of value. Could you use the term store of value and inflation hedge interchangeably?
I think to some extent. So I mean, you can say, for example, that if you buy oil fields and you buy copper deposits, those are commodities, those are inflation hedges, but you're also trying to store your value against, say, fiat currencies with perpetually negative real interest rates, and currency devaluation and inflation and risks of hyperinflation because you're trying to hold scarce assets, productive assets, things that require real world inputs. And so when we look at Bitcoin, the complicating thing there is that because it's still young, it still has high volatility. Store of value becomes kind of a controversial term for it because generally, with a store of value, your mind naturally goes to low volatility. And so the way I describe Bitcoin is that it's an emergent store of value. It's basically a new technology, a new type of money, and it's currently finding its place in the market. So this past kind of call it 12 years, 13 years has been Bitcoin rapidly coming up to whatever market cap it's going to eventually kind of settle towards, or percentage of global asset it's going to settle towards. Whereas gold, for example, is an established store of value. So I think Bitcoin is on track to likely becoming store of value. But basically, you're in the earlier stage of investing in the idea that it's going to go through that S curve and become a store of value. So I think emergent store of value is probably the closer way to think about it.
The characteristics of Bitcoin you just mentioned, including an emerging store of value and potentially hedging against inflation, those characteristics, can they be applied to the rest of the cryptocurrency market? In other words, would you sell your house right now, Lyn, and buy Shiba Inu?
I would not. No, I would skip that one. I mean, those can be useful speculations for some people, but I'd be very cautious about considering those stores of value. And the main difference is that so Bitcoin is kind of achieved sufficient decentralization, meaning that there's not really any party that's able to change its monetary policy, change the how it works. And so we even saw that in 2017, the majority of miners, the majority of large crypto exchanges, the maker of most of the mining equipment, some prior lead developers, they all kind of teamed up to try to change the way Bitcoin worked in terms of its block size and basically, have that play out. But they couldn't really get through how the decentralized the node network was. Basically, Bitcoin's kind of designed with that division of powers between developers, miners, and node operators. And so they weren't really able to change it. Whereas some of these other protocols, because they're more centralized, they're able to change. Now, for some, that can be a feature rather than a bug, because if they're trying to achieve a purpose, they can iterate quicker and get their protocol to do what they want to do. But I don't view those in the same way that I view Bitcoin, which is essentially decentralized money. Whereas those other ones I view more like a tech equity in the sense that you're betting on the development from like kind of a more centralized team, not necessarily a fully decentralized team, but in some cases a rather decentralized team, and you're kind of betting on that protocol changing over time to meet whatever needs that people want to use it for.
Okay. Now, Bitcoin has breached new all-time highs recently, surpassing its previous all-time high in the spring. Some speculators are saying that, well, it's time for a pullback because that's what Bitcoin typically does when it breaches an all-time high. Others are saying, well, because of the recent momentum, it's too strong to issue a bearish narrative now. So where do you stand?
So overall, we already seen somewhat of a pullback. I mean, it went up to something like 67,000. It came back down to something like 60,000. It's been bouncing around. I don't have a strong view over the next few weeks what it does. Overall, the on-chain indicators generally look pretty bullish at this time. Now that we have Bitcoin ETFs, you have to watch the futures markets as well. It's obviously it's gotten more complex in order to map the kind of intermediate direction for Bitcoin. But overall, I'd say that the bullish case is in my view a lot stronger than the
Right.
bearish case when looking out, say, 6 months.
And I think people have to be somewhat cautious because, yes, a Bitcoin ETF could be a very bullish case, but it's also providing investors another avenue to short Bitcoin, right?
It provides an avenue to short it. It also provides arbitrage, right? Because you
Yeah.
can short the futures and buy the spot, which all else being equal is pretty good for Bitcoin. It also basically makes it so that because those futures are cash settled, you potentially have a rehypothecation issue, which is something gold has faced over the long term. And so there are some advantages and disadvantages. I think the overall advantage is that it showed that the SEC is at least somewhat on board with Bitcoin. We've seen spot Bitcoin ETFs in other markets. The SEC hasn't gotten there yet, but a futures based product kind of reduces, I think, in investors' mind the perception of a regulatory crackdown in the United States, at least. And we're also seeing more regulations around banks being able to custody it, banks getting into the space. Basically, it's kind of hitting critical mass in terms of regulatory acceptance, which I think is important for some of the large pools of capital. So even though I personally wouldn't want to own a futures-based Bitcoin ETF, I think there's an important signal there to big allocators.
Okay, finally, I want to ask you about the concept of a Bitcoin or a crypto winter. I've heard this from several analysts I've spoken to. Last time we had a high in 2017, the Bitcoin price corrected by a tremendous margin and then stayed flat for a number of years before regaining its strength earlier last year. Do you think that could happen again this time, next year?
I think it certainly could happen. There are a couple factors that I think are different this time. Because remember, that's a pretty small sample size. Bitcoin's been around for 12, 13 years, and it goes through these 4-year halving cycles. So those winters occurred kind of in the second half of a halving cycle, and so we're talking about a sample size of like three. And so I think when we extrapolate that out, we have to be aware of a couple differences. One is that as Bitcoin has kind of reached the later stages of its distribution, right? So in those earlier markets, that the amount of new supply of Bitcoin was still pretty high, whereas because of those supply flow halvings, almost 19 million Bitcoin already exist, and the other 2 million are the ones still to be distributed. And so those halvings, I think, will matter less and less going forward. We're also seeing that, for those prior cycles, the amount of Bitcoin on exchanges kept increasing. So there were kind of local periods where it would go down a little bit, but generally you had a structural, persistent increase in the amount of Bitcoin on exchanges during both bull and bear markets. Whereas ever since around March 2020, we've seen a pretty persistent drain in Bitcoin from exchanges, and that's kind of partially tied to the fact they were kind of near the end of its supply distribution. At least in it's going to be distributed out for about 100 years still, but it's asymptotic. So we increasingly get the majority of coin distributed, and so that changes the supply demand constraints. The last thing I'd point out is that because of the way that mining has shifted, so it used to be these small operators, many of them in China, but as we've shifted more towards professional operators, and as we've gone into North America, especially publicly traded companies, a lot of them have better access to capital, so they can issue equity, they can issue loans that are backed by their Bitcoin collateral. There are a lot of institutions in the space that over the past 2 3 years have studied the space. They know how to lend to miners now. They feel comfortable with that risk. They have that specialization, and so because of that better cost of capital, a lot of miners don't ever have to sell their Bitcoin. So we have publicly traded miners where their goal is to mine Bitcoin and then hodl it. And so that somewhat changes also that 4 year supply, halving cycle. And so I think whether or not we get a crypto winter will partially depend on how euphoric it gets in the first place. So in those prior crypto winters, you got extremely high euphoria in Bitcoin and other cryptos. Whereas I think here you've not, by most indicators, you've not seen Bitcoin reach those lofty heights of euphoria that you've seen in prior highs. But if it were to get to a very high level, I do think you'd have a longer cool off period. I just don't know if it would last kind of the same length of time. It really depends on it's more about demand in my view, whereas supply is already getting pretty interesting how tight it is.
All right, excellent. Lyn, I appreciate your thoughts. As always, thank you for coming on.
Thanks for having me.